Here in Frankfurt, German school vacations are expected to start tomorrow. So the question is, how shaky is the economic situation and what is the indication for equity markets going forward? Because equity markets recently in the US again have been marking new highs. So the question is that sustainable? The question for German portfolio managers is whether to chicken out in terms of the risky markets in anticipation of more volatility during summer. Well, let's have a look at the economic situation first. Economic expectations are basically unchanged. We have solid expectations towards 2.53% growth in the US this year. That's quite stable. But in Germany, we're muddling along between 0 and 0.5% in the economic growth expectations. Purchasing manager indexes also are critical in Germany. They've been going down, especially in the manufacturing sector, and the Eurozone overall PMIs been coming down slightly towards the 52 mark, in Germany towards the 50.4 mark. So it's a critical picture a bit with the purchasing manager indexes losing dynamics. Exception is the US holding up quite well, so global PMIs are okayish on the 53 mark on a quite solid expansion path. So what about politics, interest rates and central banks? We had quite a high volatility in political expectations and the political environment over the past weeks. Not only the discussion about Joe Biden and Donald Trump in the US, but very interesting French election results with a high volatility from one week to the other. And especially interest rates reacted quite significantly on the French elections. We had an expansion in the interest rate differential to Germany of up to 50 basis points, now narrowing down to 30 basis points. So truly election results have an impact on interest rates. We assume that the French premium into next year, given the political uncertainty and given the long time period we need to sort the election results out, will probably be around 30 basis points higher than it used to be before Macron called for the new elections. In the US, Joe Biden is an uncertainty, but interest rate environment quite stable in the US, and the focus goes on CPI, consumer price inflation expectations today. We had results out for Germany, finally confirmation that inflation is running at the 2.2% rate for Germany, which is quite solid, which is underlying or basically a confirmation for the European Central Bank's policy of lowering rates. In the US, expectations are inflation rate is going to come down. We had the core rate coming down to 2.6%, which also has been a surprise. Expectations for consumer price inflation is 3.1% for coming later in today. So inflation picture is fine. Interest rates are quite stable, 4.3 around for the US, around 2.5, 2.6 for Germany, slightly premiums or higher differentials for Italy and France due to political uncertainty in Europe. Into the second half, we expect actually the CPI picture, consumer prices, to be quite relaxed on the same level, maybe slightly increased due to base effects from the oil price that kind of level out. And interest rates also expected to be more in a sideways range, quite stable. Finally, we have to look at the equity markets with astonishing returns year to date. Here in Germany, a meager 10% compares to plus 18% for major indexes, the S&P 500 in the US, and even a plus of 26% for Japanese indexes. So record returns in equity markets, and the question is, can that continue into the second half? Conditions are that we start tomorrow with the vacation in Germany, starts the earnings season in the US. We have 3 major banks reporting tomorrow, and astonishingly enough, banking analysts anticipate good earnings again for the banks, and even anticipate with a more stable interest rate and a more solid interest rate environment in the forecasts that banks have actually good earnings expectations for the next 3 years. They also expect a new earnings cycle for the banks. So that could drive market, could actually bolster market in the underground. And besides that, the question is beyond financials, what about technology? What about the artificial intelligence hype? There it looks like actually the expectations, the high expectations, the high visions on artificial intelligence can translate into earnings. We see that in the semiconductor space, but also in other segments, software. So there's quite a good possibility that solid markets can continue, that we get rising markets again in the second half. The stable interest rate assumption that we had earlier is also a prerequisite for that. So stay tuned in equity markets. It looks on, we have to hold on to risky assets despite higher valuations. America has a 30 PE, Germany has a 19 PE. So it's expensive, but it's probably going to get more expensive into next year.